Here's a question most Aussies can't answer. If you weren't able to go to work for the next 6 months because of illness or injury, how would you pay the bills? Most people assume that they're covered. They think that their superannuation is going to fix themselves up. They think that their employer is going to look after them, or they'll fill in the gap with Centrelink. The reality is, superannuation isn't really designed to make up for that loss of income. Specific insurances aren't there to cover your monthly bills, and for most working households, Centrelink won't even be able to cover most of the expenses for a day-to-day lifestyle. So when people say that they'll be fine if something happens, it's based on assumptions that don't really line up at all. Quick heads up before we go on, this is general advice only, not personal advice, so if you're wondering if it relates to yourself, feel free to speak to a licensed advisor. I'm Brian Carney, I'm a director here at Redwood Financial Planning, and we run our own Australian financial services license. A big part of what I see day to day is people thinking that they're covered until we get into the details. Now, income protection is one of the most misunderstood types of cover. At its core, it pays you a monthly income if you aren't able to go to work due to illness or injury. It's not a lump sum, it's not a once-off payment, it's designed to replace part of your income whilst you're recovering. So if you're off work for 3 months because of illness or injury, your income protection will cover a part of your monthly income for those months. That's its whole job. It's there to keep money coming in whilst you're trying to get back onto your feet. Now, this is where people often get confused. Income protection is for temporary disablement. It covers you while you're unable to work, but expected to recover. If you become totally or permanently disabled and are unable to go back to work, that's when your TPD kicks in. And this is a completely different policy to your income protection. A lot of people think that income protection protects them forever. It doesn't. It's there to keep your bills paid while you heal, not to cover you for the rest of your life. Most income protection policies cover you for 70% of your annual income. So if you're earning $100,000 a year, $70,000 gross is able to be protected in that income protection policy. And people might be asking, well, hold on, why isn't it 100%? The whole idea of income protection is to cover your living expenses. It's not to put you in a similar position of income without even going to work. So it's designed to replace most of your income, not all of it, because then there would be absolutely no reason to go back to work. So next is the waiting period, and this catches a lot of people out. That's the gap between when you stop working and when payments actually start hitting your account. Common waiting periods that we see are 30, 60, and 90 days. If you've got sick leave or savings stacked up, you can extend the waiting period so you don't have to pay as much on your insurance policy. If you don't and something happens, those first few months can be very uncomfortable. The benefit period is how long the insurer will keep paying you if you're still off work. Some policies pay for 2 years, others pay for 5 years, some can even go all the way up to age 65. If you're off work for longer than the benefit period, your insurance is stopped. Longer benefit periods cost more, but it gives you much more certainty if you're unsure of how long it's going to take for you to recover. There are a few things that income protection doesn't cover you for, and this is where people get caught up. It generally won't cover pre-existing medical conditions straight away. It's not there if you want to quit your job or anything like that, and it's not an unemployment insurance policy. You need to be unable to work due to illness or injury confirmed by a doctor. The exact definitions matter. That's why policy wording is so important. A lot of people also don't realize that income protection can be held inside super as well as outside of super. Now, inside super, your premiums come out of your super balance, and that feels easier day to day, but that's also going to affect your retirement balance. On the other hand, outside super, you pay for the insurances yourself, but you own the policy outright, and you also have tax deductible abilities depending on your marginal tax rate. The biggest difference is cash flow and control, whether you want the superannuation fund structuring it inside super, or whether you want to hold it outside of your superannuation and pay it with your current cash flow. Income protection isn't exciting, but it's practical. If you rely on your income to pay your bills, it's the safety net to protect yourself whilst you're recovering from a situation. Most people either don't have it or they have it and they don't actually know what they're covered for. If you ever want to check out how much cover you have, how much it will pay, or if it's still relevant to your circumstance, we run strategy sessions. Feel free to book in some time and we can go over your specific situation. Links in the description below. Thanks for watching.